Time. Let's get back to our conversation because Anastasia, Kristen said something interesting, right? And Greg alluded to this too. You don't know the P because you don't know the E. You're not going to know any of this for a while. The expectations are that they're both going to be depressed in the environment that we're in. Yet you say that it's a good near-term tactical entry point.
Look,
how do you buy stocks not knowing those two questions?
This is a trader's market for sure, and I wouldn't stay in it. But given how oversold we are, and given how relatively little event risk we have in October versus September, I mean, coming into September, I was quite bearish, calling for a 3 to 5% market pullback. We got 9 instead. And part of the reason was that if any of those events went wrong, you had the setup for a pullback. Now you're sort of on the other side of that. And we don't get CPI until the middle of October. We don't get the next Fed decision until November 1st or 2nd. And by the way, the earnings season is upon us, but the downgrades were already quite severe. The analysts cut back those earnings revisions by 6.3%, which is versus 2% that they typically cut those back. So I think a lot of these bad news is in the price. And again, I'm not suggesting, you go all in on risk, but I think you can trade this. I want to agree with something that Kristen said is the relative value for stocks has clearly deteriorated, right? If you take a step back and, if you think about just how the yield curve changes people's behavior, how they invest, borrow, and spend, that's all going to change, and that's going to lead to the deceleration of the economy. So trade it, but probably don't stay in it.
So, Greg, back to you. Are you playing cash under the mattress, or are you still invested in the stock market? And if so, where?
Right. And so we went through this, we talked about this a little bit last time. So we've had historically low exposure all year. We have had a put buying strategy that obviously worked out well when, I was at 3,600 and the market was at 4,700. We are figuring out what to do at this juncture because now that my targets have been reached, the question is where do we go from here? There are some places that we've hidden out where we need to have exposure, where I will continue to hide. Energy is a big one of those. Okay. Although we've seen the natural gas prices retreat in Europe because they've largely filled their reserves, they'll have to replenish those reserves at some point. And, the Nord Stream pipeline doesn't appear to will appear to be functional for quite some time. Even oil, while it's pulled back, we are setting up for quite the supply shock. We have 427 million barrels in the strategic reserve, which for the first time in history is less than we have in commercial storage. And at the end of the day, we're not in a position to aid Europe if Russia decides to pull back its oil, if the boycott does in fact end up being placed and affected in December as they projected.
So this, Kristen, goes to kind of what you want to do and where you want to do it. And back to the Delivering Alpha survey that we did, the asset class where I will be most aggressive for the rest of 2022, I'm surprised by the answer here. Near 40% say stocks. So given all of the other options, now 19% say bonds, so you're getting, you do have a healthy vote there, and 19% say cash. Let's call cash bonds are equal to what the exposure wants to be to stocks, but 39% still want stocks.
I think the thing is diversification works in these markets. And so one of the things that we've been doing within our portfolios is really leaning into quality and preparing our portfolios for if we do tip over into a recessionary environment, how do you want to be invested? So when we look at equities, we want to be in those sectors that have actually been able to consistently grow their earnings through the past 3-4 recessions. Healthcare is there, growing 8% over the past 4 recessions. Consumer staples around 5% earnings growth. And so having overweights to those areas in your equity portfolio, I think if there's any positive news, if we can extract some positive news from everything that has transpired.
We need some, please.
Just a couple years ago, 40% of the world's government debt was negative yielding. We now have a 2-year that's over 4%, 4.30, somewhere in that ballpark today. And so for short duration, medium term duration, when we look at high quality fixed income, whether that's treasuries, investment grade debt, now yielding around 5 to 7%. Even preferreds are an interesting part of this market in high single digits. Being able to source reliable sources of yield is a way of adding diversification and getting through what's going to be volatile and choppy markets.
Last word to you.
Speaking of volatility, use that to your advantage. Now the volatility is high. Now you've got the put and call implied volatility in the 98th percentile over the last 10 years. That means that investors can actually use that to their advantage, sell the calls, sell the puts, do it on the indices, do it on favorite stock positions. But that's another, silver lining to use to your advantage.
All right. Good stuff. Thanks, everybody, for being here.